Hello, everyone. Welcome to another Autos Trading live strategy session. This is Richard Van Rich here with Jeff Tompkins. Got Craig Ward in the chat. We're really excited to have you guys with us here tonight. Got a lot of great information to go over. It felt like we were here maybe a month ago, but it was just last week. There's been so much that's happened in the market and the world and NBA trades and all kind of crazy stuff. And man, we got a lot to go over. So if this is your first time on one of our live sessions, you notice that your microphone is muted. That's so we can all hear Jeff and I talk. But there is a Q&A box. So if you have any questions throughout the evening, put those questions in the Q&A and we'll get to those throughout the evening and also at the end. If you have to hop off, you get bumped or anything like that, don't worry, this is recorded and will be available in the members area later this evening and also on YouTube. So if you haven't already subscribed to our YouTube channel, where you're going to see a lot of other videos coming through there in the coming weeks. If you have any questions about your own accounts, subscriptions, access to trade trend, anything like that, or Zillion, email support@autostrading.com and we'll get to those in the morning. So before I bring on Jeff, let me just read the disclaimer. Trading securities and options involve risks. Prior to buying and selling an option, an investor must receive a copy of characteristics and risks of standardized options. Investors need a broker to trade securities and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to the time-critical nature of trading, broker fees and activities of subscribers, there's no guarantee subscribers will mirror performance, and performance numbers shown are based on trades users could enter based on the trade signals. All right. Well, it looks like everything's up. We got a lot of folks on. Let me hand it over to Jeff. So, Jeff, if you want to grab the microphone and the screen.
Hey, guys.
There you are.
Hey.
All right.
Good to see everybody. Well, I guess I can't see anybody except Richard, but good to have everyone here. That would be entertaining if we had videos, cams on every attendee. That would we should try
I've
that.
seen videos like that, like a lot of the other traders, and you see just like, mostly it's just like guys just like laying down on the side or like in the car, just like eating chips the whole time.
Yeah, it would be entertaining. That's for sure.
It would be.
All right, cool. So, yeah, we got a good group on tonight. Good to see everybody. And let's go ahead and get to the agenda. So we'll start out with our market overview. We got some interesting things going on in the market right now. And yeah, it's going to be a fun session tonight. We're kind of at a little bit of an awkward point in the market, but I do want to talk about kind of the shift in sentiment in the market tonight. And I am becoming more convinced that this really long secular bull market that we've been in is coming to a bit of an end. And we'll talk about how that generally plays out. I mean, it's usually, people tend to think it happens like on one specific day and, you know, it's over, but it's really not how it typically works. It's generally like a process. So really, a lot of my colleagues, including myself, think that it really probably ended back in 2019, 2020 is really when that whole shift started. So we'll talk about, you know, how that happens, why it happens, what it looks like as we look at the overall markets. And right now we're seeing the VIX retreat. So we're going to take a look at that and what it means for near-term price action in the market. And then we're going to focus on using stop orders to enter trades because it's a kind of a key methodology we use to trade momentum. And that's what we're going to be talking about tonight. And in my opinion, one of the better ways to enter the market versus using market or limit orders. And then we'll open it up to allow you guys to share any symbols you want to look at together tonight and wrap up with Q&A. All right, so let's go ahead and I'm going to go ahead and turn off my camera so you guys can see the full screen. Let me see if we've got our data refresh in our Zillion dashboard here. Looks like we're still waiting on it. Oh, let me actually just check the S&P. It's possible. Okay, yeah, we're still waiting on our data refresh. We'll give that a couple minutes. So let me talk a little bit about the um, kind of the way the markets work in terms of secular bull and secular bear markets and how those tend to shift. Because typically, as I mentioned, the expectation is, all of a sudden the market's just going to fall off a cliff one day and the bull market's over. Well, it doesn't really generally play out that way. It tends to be more of a gradual deterioration of the market, usually precipitated by, your big names like Amazon, Facebook, or Meta, I guess now, Google. A lot of those big names start to kind of drag everything else down. And then we see kind of the whole structure gradually collapse, and we no longer continue to hit these new all-time highs. So obviously, over the past decade plus, we've been continuously, hitting these new all-time highs, and that tells us, we're in a very strong secular bull market. But at some point, that's gonna stop, or at least pause for a period of time, and it's inevitable. You go from bull market to bear market to bull market to bear market. And sometimes those periods can be very prolonged. I mean, they can be many, many years, even decades, even a couple decades long. There have been 20-year bull markets. And generally that's followed by when you have a very long secular bull market, we tend to have a longer secular bear market. We haven't seen one of those really. The last technical secular bear market was in 08. But there was also a crash involved with that, the housing crash, right? So, but rather than the crashes that we've seen as of late, most recently we saw, I don't know if we really classify this as a crash, but certainly a strong sell-off in January. We've seen a number of those, certainly many more than the average since the crash back in March of 2020. So that has, up until this point, resulted in rebounds and new highs in the market. So once one of these sell-offs doesn't end up in us posting new highs on the major indices, that's a good warning that the bull market may be shifting to a bear market. And we're a ways off, from previous all-time highs on the S&P. And that generally will, actually start to take place sometimes even years before we actually see sustained downward trends in the market without hitting new all-time highs. And interestingly, obviously the way the markets are structured and the way they work, we're not going to hit new all-time lows in the market, like in the case of a secular bear market, like we do with a secular bull market, right? We hit new all-time highs, and then we see some sort of retreat to lower prices. And even if that shifts into a bear market, we're not going to see the market drop to zero. So it works a little bit differently, but the reason that often is set in place, sometimes even years before we witness the actual bear market, is just basically human behavior. So, and I think a good case study here is the Corona crash from 2020. When you see some sort of major event or catalyst cause a large downturn in the market, in that case, from peak to trough, it was around 30%. Technically, from a peak to trough basis, that's considered a bear market, anything 20% or greater peak to trough. But it really wasn't a bear market because we rebounded and then posted new all-time highs. But the reason that happened, well, first of all, backing up one step, the significance of that sell-off, I should say the magnitude of that sell-off, tells us that likely prices were overinflated at that point, because we dropped 30% in a sort of a black swan type of scenario. When you see large drops that quickly, that's our first clue that prices were overinflated all the way back then at the beginning of 2020, and likely even going into back to 2019. So that's our first clue. And then even though we've since far surpassed those highs from 2020, that doesn't mean that the bull market is still intact, because the way human behavior works is people fear missing out on uptrends in the market. They don't want to miss out, and they want to be a part of that and make money in it. So when you look at valuations, generally you get the way that bull and bear markets work, secular bull and bear markets, is you get overinflated values followed by underinflated values. And that's where eventually stuff gets oversold too far, and then it rebounds. Or conversely, from going from bull to bear market, things get overbought too much and then it drops. And so when you look at valuations, we know that things are overvalued. That's a major warning sign that even though the market can continue to go up when things are overvalued, it's eventually going to lose steam and go down. And we can tie that using an analogy to interest rates, to inflation, right? So the Fed kind of works the same way. They get the economy going and they get it really hot. Basically money's free. It doesn't cost hardly anything to borrow money. Handing out for free, you get an economic boom that then eventually gets out of control, and you get high inflation. And so the Fed then has to overreact to reel that inflation in, slow it down, and reverse it. And then they do that by raising interest rates, and then money becomes more expensive. It slows the economy down, and eventually people stop doing things like building new homes, new buildings, because it's too expensive. And then that with many other things impacts the economy. It hurts the economy, and then they have to overcorrect and lower rates back down. So it's this constant overcorrection that we see in so many things economical, including the stock market. So things get overinflated, overvalued. And when people think of, when we've witnessed what we have with, the market being on a strong incline since the crash of early 2020, and, how could, in the midst of this major pandemic and all these, global government shutdowns, continue to see a stock market going up? It's for that exact reason. It's that things are getting overvalued, and it just takes time. It doesn't all happen in one day. It happens gradually, and eventually, the big money, the institutional investors, pull money out of the market, and there's nothing to get it back up. And right now, the catalyst really is inflation. So it's going to be very difficult for this market to keep going up in the midst of our high inflation rate. So
Jeff, I have a quick question for you. So for you, what was the catalyst for you to believe that okay, now we're at a point where I feel like the market's more set to go down than continue to go up?
Well, it was really, like I said, back in the Corona crash in March of 2020. That's when I realized, okay, at these prices, the market's overvalued because of the magnitude of the decline in that black swan event. But that obviously, since then, the market's gone way up, which I also expected, because that's what happens.
Yeah.
Until you get a clue that something's overvalued, you don't know when we're going to shift from the secular bull to the secular bear market. So it's nearly impossible to pinpoint when that's going to happen, since it takes place gradually. But when that happens, like, back in kind of late 2019, early 2020, when we started seeing, and maybe even you could really even make a case going back 2018, because we almost saw a peak to trough sell off of 20%, I think, in the Nasdaq at the end of 2018. When you start to see those kinds of quick drops, then any rise beyond that point is overvaluation. So then from that point, you want to have your radar up, and probably with good likelihood, with it sometime within the next 2 to 3 years, that bull market's going to be over. It could happen very quickly. It didn't, right? Because if this really was all set in place back in 2018, 2019, then now being in 2022, it's continued to go up for a couple of years. But we know that historically, in 2 to 3 years after an event like that, or where you're seeing peak to trough sell-offs of 20% or more, that's your first warning sign. So to answer the question, then the real thing we need to look out for is what's really going to push the market over the edge. And again, it doesn't have to be an overnight sell-off. It could be exactly what we're seeing now, and I think it is exactly what we're seeing now. And that would be inflation. Inflation's one of the biggest catalysts that's going to derail a bull market, and it was just a matter of time before it happened because of that human behavior. It's human psychology 101. It's just the way that people react to rising prices or rising inflation. So I think right now it's the inflation that's going to be the catalyst that is going to ultimately put an end to the bull market. And I hope I'm proven wrong, and I hate to throw predictions out there, because that's my job, isn't to predict things. It's to use statistics and probabilities and risk management to make money in the market. Because to me, trading and investing isn't about prediction. It's about all those things. And a lot of times people get caught in the trap of thinking they have to be able to predict something accurately to make money in it, which is not the case. We really just need to use probabilities and statistics and risk management, and be able to, follow trends and things like that. So I think that's what's going to cause the shift here. And we're kind of seeing that. Let me go ahead and refresh the dashboard again real quick and see if we can get today's data up here. We're kind of seeing that. So, things are shifting, and we're not getting back up to those previous all-time highs so quickly. And the fact that that's the case in the context of high inflation is the worrisome factor. Well, worrisome for people who don't want to be in a bear market, but some of us want bear markets. Can actually create opportunity. I've been looking forward to a bear market because it's just going to create buying opportunity, especially if you're a buy and hold investor. But if we see the market go down 50%, that's like we did in 08. The second half of 08, I think the market went down about 50%, maybe more, a little bit more. Can you imagine if, how many of us wish we had the DeLorean to go back to 08 and buy up as much as we could with our portfolios at the end of 08 before the new bull market started, right? I mean, you would have gotten in very, very low. So yeah, those are the things we kind of want to be have on our radar right now. And I just wanted to kind of start out with that because I think that there's a good chance the bull market has lost its steam. Our data update's taking a little longer than expected. I'll go over to broker platform. So let's take a look at kind of our key levels and what's happening in the shorter term. So obviously we've gotten the sellout. There's our slingshot. We looked at that in our last week's session. Followed it up. It started a couple sessions ago, but followed up on that. last week, the completion of our slingshot. If you guys missed those, you can go back and check those videos out on our YouTube channel or in the members area. And then we got back up and then we sold off again. We're kind of seeing a double top here on the S&P right around 4,600. So 4,600 is going to be a key level to watch on the S&P for resistance. Okay, so 4,600. And what I think, and I talked about this last Tuesday, I think that we're probably going to see a retest of these lows down around 4,300, major support. And I think if 4,300 breaks, we see a sustained break of 4,300, that's going to be even further confirmation that we're shifting over into a secular bear market. But right now, this is a tough time to trade because there's a lot of whipsawing, and when we get stuck in these ranges, it can be a bit tricky if you're not using the right strategy. So we want to make sure that we're really respecting and monitoring these support and resistance zones here. So on the downside, 4,300 is our major level of support, and to the upside, 4,600 is our major level of resistance. And right now we're right in the middle of that. So this is where it gets tough. So when you see price in the middle of a range like this, probably it's better to sit out, depending on what strategy you're using. Maybe, it might be conducive to certain option strategy like the iron condor, for instance, where you can place spreads on either side of the range. But just for analysis sake, this is when things tend to get the hardest for people, is when we're right in the dead center of a very strong channel with very strong overhead resistance and lower support. And that's where we are right now. We're just right dead center, in this range as of the close today. And we see a bit of dynamic resistance here with our middle volatility band, and did actually close above that today. So in terms of near-term projection, I expect we might see an increase, a brief increase in the market. Maybe up into 4,500 would be a level to watch for near-term resistance if we get up there today. Because if you look there at that 4,500 level, we got very strong resistance. See this from back in November of last year. That's a significant inflection point, because you see a big sell-off into that level and then a big rebound from that level. So this 4,500 is also a significant overhead resistance level to watch before we even get to 45 or 4,600, but also 4,550 is one to watch if we do break 4,500. And you saw rejection of that here from December, okay, on kind of mid-December there, and then 4,600. And look what's happening here with our volatility band. So 4,600 is just about 2 standard deviation move from the mean. So it's the upper volatility band here is coming down into that 4,600 level. And we'll probably see those collide here tomorrow or by the end of the week. And so that's a very strong static horizontal resistance level, as well as a dynamic resistance level with a 2 standard deviation band from the moving average. So 4,600 is going to be very, very difficult for us to break. If it does, then we're looking at potentially a retest of all of previous highs. But more likely, if that does break, my projection is that we will see more of a head and shoulders pattern at 4,750. So we have left shoulder here, we got the head here, and if we do get up past 4,600 again, there's our right shoulder at 4,750. And so that would be, for me, I'd be a seller into that level if it even gets up there. But right now, for very near term, and I'm watching the futures right now on my other screen, but we're down about 1/3% on the E-mini S&P, but doesn't mean a whole lot. Volume's thin right now until European session opens up middle of the night. But if we push higher, 4,500. So the case, for a near-term move higher is the VIX, because remember, we always want to be monitoring what the VIX is doing in the context of the S&P. And we are seeing the VIX retreat from its recent spike. So we had this, and there's a head and shoulders pattern on the VIX too. The VIX is a leading indicator of the S&P. So if we see head and shoulders on the VIX, we might see it on the S&P down the road. Nothing's 100%, but tends to be pretty accurate. So there's our left shoulder. We just formed the right shoulder there, and there's the head. So we're retreating right now from this 32 level on the VIX that we spiked up into yesterday. And generally, when you're seeing the VIX retreat like this, when the market is rebounding, that gives us a bit of a clue that there could be a sustained rebound there. And it may not be long, it may only be as short as a day. It could be a few days, could be longer. That's why we want to be checking the VIX every single day to see what it's doing. But right now it's moving down. So we want to see how far down it goes. Is it going to go back down into the 20 level, which is where it shot up from in early February? Or is it, and most likely that's what we're going to see. And even if the market's like the S&P, when I say the market, I mean the S&P, even if it's stuck in that range, kind of bouncing around, the VIX can still move back down into 20. So we want to kind of watch that for clues of what the S&P is going to do. But right now it's retreating, which tells me that the S&P is probably going to go up. There's an inverse correlation there. So if we see the VIX retreating from a spike, that's our clue the S&P is going up. And that's what we're seeing right now. So near term, I think we're going to see some rebounding. We saw it today. We saw the markets move up today quite a bit. And that occurred in the context of this VIX spike and then the retreat. So that's what's going on right now with the VIX and the S&P. And those are the major levels we want to be watching. But often, this is kind of how the VIX works. It spikes and goes down, then it spikes and goes down. There was our spike. So that's our clue that this recent downturn is turning around for the time being. So potentially for the rest of the week, we might see prices kind of stagnate or move up. But we always want to be looking at the VIX in the context of those levels we just mapped out on the S&P. So I'll pause there, see if there are any questions, and then we can go take a look at the Nasdaq.
No direct questions yet. I think it's a lot of great information. I think when we get in these periods, it is kind of confusing for most traders. You're not sure what's going to happen, and you feel like you're just kind of like you're going over the hump of like a roller coaster. And you don't know, can't tell if you're going upside down or not. And I think all this is pretty helpful for everybody. So
yeah,
so good so far.
Yeah. It looks like we got our update. So yeah, that's the, one other thing too is the Russell. Okay, we got our update. That's good. So let's look at the Russell 2000 because the Russell has really gotten hammered, and this a lot of institutions and money managers and things look at the Russell as a leading indicator for bull and bear markets. So a lot of times when we see the Russell get hammered this hard, that can be another clue that we're shifting from bull to bear. Just wanted to throw that. I just kind of popped into my head and hadn't mentioned it before. So we can look at the Russell too, and when you look at the Russell, we broke out of this range, and you'll see the Russell range a lot. It can range for months and months. And so if you look at the range which had a base around 2100 and a cap of around 2350, that was broken at the start of this year. So that's significant because we broke this major support level 2100. And now we're moving back up we already have moved back up into that level. And see what happened there? We got a big rejection of that. And now we're getting a bit of a rebound, but this is also a good leading indicator for the market. So watch the Russell, the RUT, and see if this, which is now a resistance level. So it was support until it was broken and turned into resistance, 2100. If that holds and we can't break through it, that's even more confluence to add into that whole basket of variables that can impact the market and moving forward. So I'm also watching the Russell really closely, but see how we broke out of this really long range that we were in for pretty much a year. So going back to, and you'll see the Russell do that. It'll make these big, really strong trends, and then it'll range at the top of the trend. And when you see it range at the top of the trend and then break that range, that's also a forward-looking clue that a bull market may be coming to an end and shifting. This 2100 level, as long as it holds now as resistance, and price, if it pushes off of it again, then be very ready for a sustained downtrend. And you'll see here, if I zoom in, oops. You see that confluence there. So we got the two standard deviation move, the outer or the upper band, volatility band, that has met that 2100 level. So we're seeing that on all the major indices. The 2 standard deviation move from the mean is colliding with very strong horizontal resistance. And that's when you see that happen, that's a very strong level right there at 2100. So if that's rejected and we move down, we'll see a double bottom most likely down to 1900 on the RUT. I'm giving you guys a lot of nuggets here. These levels are big, and I think I kind of missed that on the S&P, but or didn't elaborate on it much, but we'll often see that double bottom. Let me actually just flip back over to the S&P real quick. So we could see a double bottom down here around the 4,300 level, retest of those lows from earlier in the year. Because right now we've got it's another big pattern thing. We have this W, but it hasn't come down and completed that W yet. So this is a very common pattern on the indices. It's really an M in the center and a W on the out wider. So it's like, I guess I never thought of it this way before, but it's basically an M within a W. So like you got the W out here, and then you got the M in the center. Maybe I'll have to patent that. All right, let's take a look at the Nasdaq. What was that, Richard?
I said you can put it on like a t-shirt or something.
Yeah. Don't want to give away too many secrets. So let's look at the Qs.
That's why you guys got to show up every Tuesday. All these nuggets just coming.
Yeah, don't want to miss it. I'm going to be posting some of this information in the commentary on the Zillion dashboard too. So I'll probably elaborate on that a little bit and let you guys kind of know what's going on in the commentary. That can be found up here in our commentary and events and the Zillion dashboard. So interesting on the Nasdaq, we've got this slingshot. It hasn't really truly finished out. And I'm wondering, if this might be a really long-term slingshot now. I mean, technically we had a volatility expansion right here that completed very quickly. And we had a continuation of that really starting kind of right here on this candle. And so the argument could be made it was completed here, but generally I would want to see it come back up to this 380 level, 380 to 385. And tech will often lead these market shifts. A lot of times when we go from bull to bear, tech's what leads us there. They tend to get hammered, harder. And you got a lot of big names in there, so a lot of the market capitalization resides within those big tech names. So it can really have a major impact on the overall index. But again, we saw a big move up today in tech, 2.5% move to the upside. But I guess the takeaway here, you don't want to get too caught in some of these moves, right? So don't, it's tempting, when you see like, oh, market went up 2.5% today, I'm going to jump in for tomorrow for the move up. Well, be a little cautious here, and really mind the support and resistance. So let's take a look at that here real quick on the Nasdaq. And again, we're looking at the Qs because, the Nasdaq has price per share is so high. Most people trade the Qs, which is the Nasdaq 100 ETF. So we got strong resistance at 360 that we'll want to keep an eye on. So if we move up again tomorrow, we may see a rejection of that level if we even reach it. So keep an eye on that. See, even just going back to last week, there was a lot of rejection, 360, and then we had a false breakout of that level. So if we look at this candle here, it's like this is what traps a lot of people. So, oh, boom, we're going back up, not so fast, and that's a false breakout, and it was followed by a very strong move down. So this up move that we're in over the last couple days, I don't have a lot of confidence in it. So I'm just watching overhead resistance very closely. So 360 on the Qs. And then if we move back down, we'll want to watch for that double bottom, because that can even there's always buying opportunities. I hate to use Jim Cramer quotes, but there's always a bull market somewhere, and there always is. There's always buying opportunities. So even if the market's moving down overall, there still can be good points to buy in there. So 335, in my opinion, would be a good entry point on the Qs if we get back down to that level, with very tight stops. If we break that, then there's no longer going to be a support level. It's going to become resistance, and then I potentially be looking at shorts below that level. So if we were to break through this, most likely at some point we come back up, retest it, and then go back down even further. But that's really how markets move. There's our next level right around 310 to 315. If this 335 breaks. So right now for this week, 360 is the level to watch on the Nasdaq, on the QQQ. All right, I'm going to pause there, see if there are any questions, and we'll open it up to the crowd and see what kind of fun stuff you guys want to check out tonight.
Let's see. No, we already have a couple folks pitching in a couple stocks, couple tickers themselves.
Okay, yeah, we can shift over to that. Let me just mention a couple things here on the dashboard. So thinking back just a little bit ago when I was talking about the range on the S&P and how we're like stuck dead in the middle of that, I hadn't even looked at the updated sentiment gauge for today before I said that, but interestingly, we're like right dead at 50% between bearish and bullish. So for those of those zillion users out there, these are like where want to generally avoid being in the market when there's indecisiveness, because this is where you tend to get whipsawed around a lot, when there's indecisiveness, because it's basically just, think of it like as a fencing match. Like you got two people on one side, you got the Bulls and the Bears, and one charges the other, moves them back, and then they can only move back so far, and then the other one advances and pushes the other one forward with their, whatever the hell they call those things in fencing, their sword. But I mean, this is tough. Like this thing's dead center. We're in a point of indecision. So really, a lot of trading is about choosing the right strategy or methodology for the right market condition, and that's what it is here. So right now, very difficult to make a directional move or have a directional bias in the market in the near term. Right now, it's it might be more conducive to a non-directional strategy, as I mentioned, like the iron condor, if you're an options trader. We see that risk is kind of in the mid-range as well. Again, when market risk is right in the dead center of the gauge, it's going to become more difficult, because there's no, they call it risk on or risk off. So there's no risk on or risk off right now. And that's, again, leads to a lot of indecisiveness. We do see that there is a huge number of, in terms of buy-sell ratio, more sells in our algorithms than there is buys. So if we look at the overall sentiment, we're indecisive on risk and trend, but we are bearish on sell signals. So this overall weights more to a bearishness. And when we look at sector performance, we update this every single day. So again, this might look completely different tomorrow, but because the market went up today, we have tech was a strong performer today. It's what really drove the rally that we saw in the market today, followed by materials and consumer discretionary. But we have many more laggards. So utilities is getting hammered, as you can see here, followed by real estate and consumer staples. So again, this is not unusual to see in a shift from bull to bear. And we won't run any scans right now, but if we were to run our scans, we're going to see a lot more sell signals coming in. And other thing I didn't point out or mention is we are in a red divergence cloud. So this is another proprietary feature of our Zillion dashboard. The Zillion cloud, or divergence cloud within the Zillion dashboard, gives us a good clue of whether the market's going to be going up or down. And you can see this cloud shifted. The green cloud stopped way back here in September. Okay, that was a warning sign. The market did push back up. Remember what I talked about earlier on. We get exuberance and irrational buying behavior until it can't sustain itself anymore, and then it falls off a cliff. And so there was, we're out of the cloud here for a couple months, and then we get this red divergence cloud. And sure enough, that came in here late November of last year, and the market, has turned over now. So we are still in this red divergence cloud, which is also something to take note of. And I believe that's both on the Nasdaq. I believe that's also the case here with the S&P. It is. So also a red divergence cloud. We did get a faint green cloud on the irrational buying here in September, October, unlike the Nasdaq. But that quickly shifted over as the market was topping out here in mid-November, and then shifted to a red cloud. So these red clouds can also give us good warning of a turnover in the market, and it's done that very well here. So I generally look to be a seller within these red clouds on rebounds, and I look to be a buyer in green clouds on sell-offs. So that can help me. And then, of course, looking for trade trend signals. We got a trade trend buy signal. We covered this on last session, so I won't touch on it too much. Back in late January, and then we got the sell warning February 11th. So there's an open sell right now on the S&P with a stop up around the 45.35 level. So again, just keep an eye on those resistance areas, trailing stops if you use the Zillion dashboard. All right, so unless there are any questions, Richard, to address on those, we can shift over into some symbols.
There's a question from someone who's not quite familiar with Zillion with the buy sell ratio. What's that exactly?
Okay, good question. So, and I believe the development team is now updated the algorithm behind this. If not, it will be updating this, but I'm pretty sure it's updated. It includes, so any trade trend, buy or sell warnings and triggered entries. So the white diamonds are our warnings. That's what tells us if the likely direction of the market is, or whatever security we're looking at, is going to be going up or down. So if you get the white diamond above the candle, that's our sell warning. So you see we had one like here on the S&P, and then followed by a triggered entry. So not all warnings will necessarily result in a triggered entry. In this case, it did, and you can see that it was followed up by the triggered entry here on the next trading day with the sell. And that or the buy sell ratio gauge is going to include both pending signals, so that would be your white diamonds, and confirmed triggers. That's going to be either your green or yellow. It's kind of more yellowish, or red arrow. So if we see more pending sells and triggered sells, that's going to flip the gauge to the sell side. If we're balanced and we have kind of equal buy and sell signals, it's going to be more in the middle. And then if we have more buys, it's going to tell us that there's more pending and triggered buy signals from the trade trend algorithm in the Zillion dashboard. So this is more meant to be kind of a gauge for you to determine overall in the market what's going on in terms of buys and sells. So you don't want to take this as like a buy sell for anything else in the market. It's purely related to our algorithm within the Zillion dashboard.
Awesome. Perfect.
Yeah, Kalki, the Heikin-Ashi candlesticks won't have enough time tonight to get in. That might be a topic for another session. If you want to shoot us an email, it's best to email us ahead of the Tuesday sessions if there's any topics you guys want us to cover, because that one would take a bit longer. But we'd be happy to cover that on a future session. If you want it for next week, if you shoot us an email, support@altostrading.com, Richard will put that in the chat for you. Then we could potentially cover that. Heikin-Ashi, I have my mixed feelings about those. I generally don't like, I mean, they can be useful in helping us identify a trend, but I don't like when things skew or distort my view of what the actual price is doing. So the way that Heikin-Ashi candles are formed, it's a different formula. So it's not actually showing you the true high, low, and close. So these candles are referred to OHLC candles, open, high, low, close, where you're actually seeing the true high in the market, the true low, the true open, and the true close. Heikin-Ashi distorts all that, doesn't show you the actual open, high, low, close, and that can be okay. Insert, if you want to get, they can be, useful in determining trend, but my general, feeling about any kind of candle that distorts your view of what's actually happening can potentially be detrimental if you're not also monitoring or using them in conjunction with a true OHLC candle. But great idea for a future session. Please do shoot us an email on that if you're able to join on a future session. I'd be happy to cover those. And Craig will let me know about that, and we'll put it on the agenda. All right, cool. So anything else, Richard? Or we want to look at a few symbols? We got about 10 minutes.
Yeah, there's no other question, but Moshi put in a symbol like 7:30. He was ready to go.
Nice. Moshi's on
Wants
top.
to look, yeah, wants to look for actually forex. It's the pound dollar.
Okay. And I'll just, I'm going to go ahead and, oh, did we take our forex out of the, oh no, there it is. Okay. So you can find all the forex pairs in the scanner. And then sort by signal. So you can see if they have any buy or sell signals, if they're in a divergence cloud. And then you can also chart them from here or add them to your watch list. So pound dollar right now. So we have a pending sell on the pound dollar, which is interesting. I'm going to go ahead and map this out for Moshi. So I see a strong level of resistance. And you can see that it was previously served as a level of support going back quite a ways. It actually broke here in early November, then became, and this is what I was talking about, guys. I mean, this is one of the really in my opinion, one of the best tried and true all-time reliable signals is when you see a support level broken like this. If you can be patient, wait for the retest and rejection, these can be great low risk entry points that you can, enter with a tight stop. So that was a good opportunity there. And then, yeah, broke again here, obviously, came back, retest. So we've doubled. This is really strong. You see here, like over the last couple of weeks, the pound dollar, it's not able to break this 136 resistance. And then we've got a pending sell from our trade trend algo. It is in a green divergence cloud. So that would be my only kind of hesitation on the sell signal. But I do see a lot of other indication that this level might hold. And we got to sell. So you'll see, guys, if you go, if you're a Zillion user, you can, and I'll tell you guys too here at the end of our session, if you're not using Zillion, how you can get access to the dashboard. Let's see, what was I gonna, I kind of lost my train of thought there. So if I had the chart expanded there, but if you go back into the main dashboard, you'll see that the algo gives you the entry price on a pending sell. So right now, if you look at up here, you see sell pending. So that's our diamond. Right here, sell pending. Entry price, suggested entry to the short side is 134.84. So that's going to be just below the low of this candle. And I totally lost, like, I got like so involved in that secular bull and bear market conversation. I forgot, like, the real focus of our session tonight is using stop orders to get in, but this is a good point to interject that. So our entry is just below. So the reason that we use and I use stop orders for momentum trading is we want to make sure that there's follow through with the momentum, and that's how we've designed the algorithms to work. Is we have a warning, but that isn't, the point we want to jump in this case, to the pound dollar to go short. That's just telling us that the algorithm is projecting a move down, white diamond above the candle, pending sell. But what happens, if this thing doesn't actually go down, and let's say, when the market rolls over, it goes up. Then we wouldn't want to get into that trade, right? And by using stop orders, it can actually keep us out of a lot of bad trades. Because a lot of people, when they get a signal from whatever indicator or whatever they're using to make their entry decisions, they'll use a limit order or a market order to get in at that time. And that often can result in trades that you probably never would have wanted to get into in the first place. So, and that's why I like momentum trading so much. And it's really the core of my style of trading, is because I want to be on the right side of the momentum. and it helps me choose my strategy. So, and then not only that, like it helps me get in if there's follow through, and not to say there can't be follow through and then a reversal, that happens too. But in all my experience of using momentum and buy and stop orders to enter the trade, I find it keeps me out of a lot more bad trades than it gets me into, and it tends to get me into more good trades. So the sell entry price would be, which is provided up here in the dashboard, would be just below the low of this candle. So if the pound dollar does come down and follow through, then we have a potentially good entry. And it's a good way to enter because we all want to at least start the trade off in the right direction. So it pretty much allows you to start the trade off with a profit, right? Whereas if you enter with a limit and the market reverses on you right away, you're starting off with a loss that you got to make up for right off the bat. And who wants to do that? That's really kind of the, in a nutshell, the importance of using that entry technique, stop orders. If you're not familiar, they're easy to learn about, but basically a buy stop order is an order to enter the market or whatever security you're trading at a higher price than the current mark price. And a sell stop order would be to enter the security at a lower price than it's currently trading at. That's really all it is. And so you can put that on as a pending order. And unless, in this case, the pound dollar comes down to that level, then your order won't be triggered. You're not in the trade until it actually comes down to hit that level. And that's one of the really the core of how we've designed our algorithms. So you'll see these, these signals all over, like there's a warning right there. There's the triggered entry. This one didn't trigger on the next day. See, that actually did happen. If you had entered this sell warning signal with a limit or market order on the next candle, you would have been probably peeing your pants because it started to go way back up and then it trapped everybody and came back down. So as a trade trend trader and a Zillion user, we don't get into that trade right there. We wait for the confirmed entry below the candle. And on day 2, it came down and triggered that. And then we've got our trailing stops, which are the horizontal lines that help us manage the risk along the way. But you can see, boom, this thing shot straight down. We got another one down here, really nice one. So it's helping us get into the trades that have a higher probability of success and keeping us out of the ones that have a lower probability of success. So right now on the pound dollar, and this was a great suggestion from Moshi, I see strong resistance, a pending sell. If there's follow through, I might look for a move down into a prior support level. And I see support down here. Right around between 133.50, 134. So that would be kind of an initial profit target that I would look at if I were to short the pound dollar on this sell warning, assuming that it triggers. So you got some room for a decent move there. Right now, you're right in the middle of this band, the volatility band. So we're right kind of at this moving average. There is a lot of price consolidation going on right now, which if I'm looking at whenever I analyze a trade opportunity, I always look at the pros and cons, and I want there to be many more pros than cons. So right now, the 2 cons I see is we're in a green divergence cloud, so it's going against the divergence, and we have price consolidation around the middle band. Those are really the 2 cons I see. Other than that, I see a lot of pros here, and again, not an endorsement to take this trade or enter it, but just an analysis of what I'm seeing going on right now in the pound dollar. So that was a good suggestion. Thanks, Moshi. Probably have time for one other one.
General Motors.
All right, let's take a look at GM. All right. So very strong double bottom on GM. GM's really gotten hammered after peaking here back in early January. This also could be potentially a good opportunity. And here's just emphasizing the fact that I pointed out. Here was a pending sell from the algo, but no follow through. So our Our pending signals are good for up to 3 candles. So 3 days after, if it doesn't move down, and it didn't here, that was the low, the entry would have been down here below this candle. Then it's null. That's why you don't see a triggered sell like you do, for instance, right here, or right here, or right there. So it didn't trigger, and that's good. It hasn't gone anywhere, right? So that's kept us out of this trade, which up until right now wouldn't have been a great trade. It would be in a losing position if you'd entered on a market. Well, it might have been a little profit because we got a gap up, but okay. So very strong double bottom here on GM. Kind of right around 47. So let's look at what happened the last time GM hit for the 47 level. We got a buy, pending buy. We got several actually on the way up off this level and a big move up. All right, so what I'm looking for here on GM, if I were to be looking to trade GM, is a buy, pending buy. So a white diamond below the price. And then a follow through with the entry. And again, you find your entry prices on the main dashboard here. So as of right now, as you can see, there are currently no buy or sells. So you'll see up here, no trades. So I would be, for me, patient on this one, wait for a potential buy and wait for this 47, 48 level zone to really hold. And if we get the buy warning, there's significant room for this one to run because we're down at we already had one slingshot there. And this one doesn't qualify as a slingshot because it's not on the lower band. But we still have a lot of room. We're near the lower volatility band. So we did reach about 2 standard deviations from the mean. So we got room to run up here, up into the 51, 52 level. And if we break that, potentially up into the 55 level. But again, keeping a close eye on horizontal resistance, because there is significant resistance up here at 53 on GM. Okay, so definitely want to watch that 53 level if a buy opportunity comes in here. But another good one. These can be great opportunities. Obviously, a lot of volatility right now in GM, but also a great one to look at. All right, so I wanted to let you guys know before we sign off, and thanks for those suggestions, guys. Those were fun ones to look at, GM and pound dollar. We're going to be in Vegas next week for the International Money Show Traders Expo. If you guys are going to be there, it'd be great to see you. Stop by our booth. We're going to be at booth 405. I'll be there with Craig and Richard and our Zillion team. Daniel and Homo will be joining us. So we got a nice group down there with us next week. We are going to be officially launching the Zillion dashboard at the Traders Expo next week. So starting next week, we're going to our full retail pricing. So this is the last week, if you guys aren't a Zillion user, to take advantage of that 50% off pricing. So if you go to zilliontree.com, you can lock in your seat. And we have some different subscription options. Our monthly subscription at the 50% discount is only $49 a month. So you can go to the homepage, zilliontree.com, and sign up. You'll get immediate access to our Zillion dashboard. And you're grandfathered in at the discounted rate for as long as you want to be a member. We don't have any contracts or anything of that nature. So again, this is the last week to have the opportunity to get in on the early bird release. And then next week we'll be announcing the full retail launch and pricing of the Zillion dashboard. So if you guys want to take advantage of all the really cool tools and features, I didn't even get a chance to scratch the surface of those tonight. But we've got statistics. I don't know why I didn't pull up for GM that show you. Let me see if I can just show you an actual what that looks like. Let's just pull up. These are all futures. Let's get rid of FX futures. So with statistics, it allows you to select your mode, aggressive, moderate, or conservative. You can see all the stats for our algorithms. So It shows you the net profit on all trades, long trades, short trades, how many trades were generated, winning trades versus losing trades. And here's the really cool thing. It even shows you the most profitable day historically for algos on that symbol. So every symbol you can look and see. In this case with XLV, you can see that Thursday is by far, for both long trades and short trades, is by far the most profitable day to take signals from on this symbol. So it can even help you hone in on the exact day that is historically been shown the best data to take signals off that on that security. So a lot of really cool stuff that you can learn more about at zilliontree.com and take advantage of the early bird special before that expires next week. All right, so thanks everybody for joining and the great participation. I hope you got a lot out of the session tonight. If you have any other questions that we didn't get to, you can email us support@altostrading.com. Are there any final questions, Richard, before we wrap up?
No, I think we're good.
All right. Well, thanks again, everybody. I hope you guys have a great rest of the week. Keep a close eye on the markets. It's going to be an interesting week, and we'll see you next Tuesday night before we head off for Vegas. So looking forward to seeing you guys all next Tuesday. Have a good one.